make any money in GameStop?
GameStop? No. GameStop is definitely not my game. That's the whole millennial Robin Hood crowd. You know me. I'm 80% a value guy. Maybe 20% an option guy, but 80% a value guy.
Yeah, I'm mid-level in GameStop.
Okay, good. Good man.
Quick in, quick out. Yeah.
Okay, beautiful. So I'm with Logan Kane, a friend of mine, fellow investor, writer, entrepreneur. We actually met on Seeking Alpha. I was doing deep research on leverage ETFs, and he had written an article on it along with a couple other writers in Seeking Alpha, and so I reached out to him. We became friendly, and he actually came down to Florida here to visit me before. This is the second time down. So Logan, tell us about how you got into financial markets, what sort of spurred that interest, and then tell us about, from the interest, how you got into actually writing and publishing on Seeking Alpha.
Yeah, so I started investing in financial markets. I was 13 years old.
13, wow, okay.
So it was 2008, and amidst this giant crash, and I was buying stocks.
Okay.
And the timing was superb. So I got into the markets that way, really starting up as a bottom-up value investor.
Mm-hmm.
And
which is you're speaking to also an 80% value investor, yeah.
And I got with time I've gotten more into some quant stuff.
Okay.
But I've gone back to the value too. It's to your earlier point on kind of the syncretic investing.
Mm-hmm.
Like what happens when we combine things that aren't usually combined.
Mm-hmm.
They're combined in a really good way. So you do your leveraged ETFs and you make good money from that, but we also do value investing.
Yeah, very true. And the term that I like to use, and he mentioned it there, is syncretic, which comes from ancient Greek philosophy. And really it's a fusion of disparate, one might even say antithetical values or philosophies. So for me, I'm not a pure value investor like Guy Spier or Monish Pabri or Warren or Charlie.
Yeah, you have Bitcoin, you know?
Yeah, exactly. But I do certain things with leverage ETFs, with options that pure value guys might turn their nose down at. So I kind of fuse different styles, and that's why I use that term syncretic that you like.
Oh, I love it.
Yeah. So you mentioned Bitcoin. Let's go to that. And you actually turned me on to a company, BlockFi, which has been phenomenal for me because I actually transferred my holdings from Coinbase to BlockFi.
BlockFi is great.
It's great. And the reason that I feel it's great is, as I mentioned before about compound interest, BlockFi actually pays me daily interest on my Bitcoin, whereas Coinbase, it was just sitting there. So the fact that I think it was you that turned me on to it, really every day I'm getting interest on my Bitcoin and I'm buying more Bitcoin with it, which is phenomenal.
That's great.
Yeah. So what's your take on crypto and Bitcoin and BlockFi and Coinbase? I think Coinbase is going to have an IPO soon. What's your whole take on that crypto space?
So on Bitcoin, I changed my mind on Bitcoin.
You did? Okay. A lot of people have done that. A lot of conservative guys started negative and they've kind of come around.
The pandemic changed my mind.
Okay, how so?
We have a government that prints money like it's going out of style.
Okay.
And, there will be winners and there will be losers from this.
Yeah.
But as it turned out, I got into Bitcoin really just at the exact right time.
Mm-hmm.
And to the point where it's now my largest holding.
Wow.
We talked about this, not because I'm a crazy gambler, because I did nothing.
Yeah.
I bought, and it went up in value, and it went up in value a lot more.
Yeah.
And I didn't sell it, because why would you?
Yeah, exactly.
The academic research, it shows that winners keep winning in the financial markets.
Yeah.
So when we have these positions, that everybody, it's a tendency, I got a profit, let's take the profit.
Yeah.
But what happens when you sell your losers? You get rid of your losers, but you hold your winners. And you just let them run.
Yeah.
And that's what we've done with Bitcoin.
Well, yeah, you make a couple really good points on that, and it's I think I mentioned to you yesterday, about Berkshire. Let's say someone was in 1992 looking at the share price of Berkshire. Someone watching this can look up the actual share price in 1992, and But let's just hypothetically say it was 25,000. Someone could say, oh, you know, I had my chance with Berkshire. I should have bought it when it was 14,000. I missed my chance. But if you had bought it then at 25, now it's what, 300 and something. So there was really, like with the Berkshire Hathaway, there was pretty much never a bad time to buy Berkshire.
Exactly.
And so one might say that with Bitcoin, especially with some of the price prognostications out there, you see some things of 100,000 or 400,000. But for me, what I really love is, as someone who's obsessed with compound interest, and this is not a commercial for BlockFi. Neither of us work for BlockFi or know the owners or anything. But BlockFi, by allowing that compound interest, makes me much more comfortable with crypto, because when there's big sell-offs, it basically, I'm dollar cost averaging into the asset.
In some months, I'll take that interest in cash. Some months I'll reinvest it. It's really up to you.
Yeah.
It's just a fantastic way. I mean, think about all the different ways that you make money.
Yeah.
Rents, interest on crypto.
Yeah.
Dividends.
Yeah.
Capital gains.
Yeah.
I mean, even the seeds.
Option premium. Don't forget, it's Carl Icahn.
Yeah, the options are.
Yeah.
You build something that's, again, back to the Syncretic point. You build something that is a lot more diversified and a lot more resilient than a traditional portfolio.
Very true, and I think you could even take the word diversified and make a reference to another Greek, Taleb. He used the term anti-fragile.
Precisely.
So you could say that, you could use it more diversified, but you could also say, because it's more diversified, it's much more anti-fragile. Meaning it's hard for it to go bust. It's hard for it to become long-term capital management or a hedge fund that's liquidated, because there isn't a lot of leverage used. There's risk taken, but there's not a lot of leverage used. And you mentioned rents. So there's real estate holdings, there's crypto holdings, there's equity holdings, there's closed-end funds, there's BDCs, there's bonds. So it's really hard, again, to just fall on your face. And certainly there can be volatility throughout the process. But it's hard to lose the game when you have all these different uncorrelated assets.
And that's a quant principle right there. Traditional value investors, they often concentrate their risk.
Yeah, very true.
So
holdings or...
What we try to do is we really try to take and learn from the masters, and we try to do what they do best.
Yeah.
And when we find other people that do things well, we try to do what they do.
Yeah.
It's like we're thieves almost of the best strategies in the world.
Yeah. I like that.
We haven't. None of this stuff is original. It's as old as time.
Yeah.
But applying the principles in a way that are allowing us to live a life that not a lot of people get to live.
Yeah.
I mean, for you, living wholly off your investments. For me, living off of writing now.
Yeah.
And investments. I mean, this is real and this works,
Yeah.
And not only that, but people can follow along and they can learn about it.
Well,
and, we're not always right.
Yeah.
But what people can do is they can look at the arguments we're making, they can analyze them for themselves, and they can decide. And that's really what Seeking Alpha is about. Maneos compounding machine.
Yeah.
You're more independent.
Yeah. I write as a blog post there,
Yeah.
so I just writing for Seeking Alpha on the blog post there, it helps me actually clarify my own thinking.
Yeah.
It's a form of sort of financial journaling, and also tracking. So I can track that. Well, in March I was at 430,000, and now I'm at 950, let's say. So I'm up X amount between the bottom in March and now. And then I can look at certain things I purchased on the way, what I purchased them at. So it's sort of a great data, really. And actually, I just one last point on that is I learned that from Buffett. I gave you Buffett's annual reports from 1965 on. It's a great read because you're actually, and I try to do it in the same way, which is it's sort of like a historical document, because you're able to see where America was, where the world was in 1974 and 1985, where Berkshire was, what he was buying, why he was buying it. So it's almost really a historical document, a cultural document, and so that's why I enjoy doing it. And plus, like I mentioned, I've gotten great feedback from people, which encouraged me to keep doing it. You're not just talking to yourself, essentially.
Yeah.
You know, you're getting, even you said you like the comment section, people interact with you, you know. So you mentioned the non-traditional asset allocation. So it's a great time, I think, to also mention real estate. And I really learned the real estate game from two people, Robert Kiyosaki, Rich Dad Poor Dad, and Grant Cardone, Cardone Capital. He's also down here in South Florida.
Yeah.
He's more, I think, in the Aventura area. I'm a little bit north in Boca. But really, and it also kind of showcases the beauty of being alive today. And what do I mean by that? Well, you know, maybe 30, 40 years ago, you could go to the library and try to read books on things. But now with podcasts and YouTube videos, you can learn pretty much anything, really. I mean, there's someone out there that's probably going to teach you. They might charge you a fee to do it, that's fine. But you can learn video editing, you can learn video production, you can learn stock market investing, you can learn real estate investing. But really, it's those two, Grant Cardone and Robert Kiyosaki. And so for me, I take a little different path than them. They do more multi-family apartments, and I do trailer parks. I had at one point 53 units under ownership, under management, and I sold one for a nice profit. And so now I have 24 units.
And the vineyard as well.
Yeah.
That was a nice real estate.
That was. It actually ended up being a nice sort of vineyard real estate development. But the trailer parks I love because it's cash on cash returns compared to other real estate asset classes are phenomenal. And just having real estate is such a great companion to the brokerage accounts because you get certain tax benefits, depreciation, so on and so forth. And so, and also, you know, you don't have to live on your stock market holdings. And that's an important thing. In the letter that I read earlier, I talked about being able to put $18,000 back into the Maneos compounding machine. If I had to live on that option premium or dividends, I wouldn't be able to put that back. If I weren't able to put that back, it would detract from compound interest. So the real estate provides, I would say actually, a replacement for a 9-to-5 job.
Oh, yeah.
You know, so for those of you out there, maybe some people are watching this and thinking, you know, I have this job and I don't really love it. How do I get out of it? And the advice that I would say is if you're sort of suffering through that, but you're saving that. You're saving a certain amount to really make a play in real estate, or you can say brokerage account as well. But really, the cash flow from real estate is one of the few things in life that enables you to not go to a place and get a paycheck.
Or online businesses is out there.
True, very true. There's a lot of online entrepreneurs as well. But real estate is certainly one of those. So I like to have, you know, for me, I don't see myself going the route of Robert Kiyosaki or Cardone, where I think Cardone has 4,000 units under ownership. Kiyosaki, I think, has 8,000.
Stress.
Yeah. Just the management of that. I would like, in an ideal world, I'd like to have maybe 50 to 100. That would be ideal. So it's another couple acquisitions.
Yeah.
And then the rest more in brokerage and because I enjoy actually the stock market stuff more than the real estate because it's more intellectual. Mm-hmm. It's more reading, research. There isn't that intellectualism that I find in the real estate game.
And what we find is that there's stock market people and there's real estate people.
Great point.
A lot of times the stock market people, they won't do any real estate.
Yeah.
Like they think real estate is beneath them or
Yeah.
unprofitable.
Yeah.
And then you have real estate people who
hate on the stock market.
Hate the stock
Even the two guys I mentioned, a lot of times they really like, oh, it's going on. How does that feel to own stocks today? Or stocks the next crash is going to be bigger than 08 or March of 2020. So that's a great point. And that goes back to the idea that we talk about syncretic.
Yeah, why
You're
not
taking antithetical positions perhaps and doing both, you know. But yeah, that's a great point he brings up. Is you'll often find that is the stock guys don't do real estate, don't understand it, don't like it, think the returns aren't as good. The real estate guys the same thing. It's like pick your camp, you know. I'm in both camps.
Yeah, and the combination of those two, because traditionally a stock portfolio If you're good, I mean, what do you think? You turn a profit 5 years out of every six out of every seven, something like that?
Yeah, it really comes down to CAGR at the end. But yeah, you might be down for 2 or 3 years in a row, but then there's 1 year that makes up for those 2 or 3 down years.
My point is that it can be somewhat hard to live only off of the stock market.
Totally.
In real estate, what it can do is it can provide consistent cash flow. You know, the stock market, it's great for paying for cars and vacations, but as for monthly bills, it can be, when the market's down big, I mean, you got to sell to pay your bills. It makes the drawdowns much worse.
Totally.
If you're all in on real estate, it can be really liquid. If you have problems like Florida hurricanes. When you have both, they're better in combination than either one is individually.
I completely agree. And that's how, you know, we're in 2021, and it's like, where do I see myself 2025, 2030? And that's kind of like how I see it developing, is that, you know, maybe 50 to 100 units of real estate, and then the rest is really kind of continue to refine my option strategy, reinvesting the premium, reinvesting dividends. And, you know, right now, before I was flirting, you know, with that million in the brokerage accounts. Now it's pulled back a little bit with the sell-off, but it's still close. It's still in that 900 range. So, you know, for me, my next goal is to really cross that million number. But if you add the crypto, I'm well over it.
Yeah.
But if you just do pure brokerage accounts without crypto,
it's been quite the ride.
Yeah. and you know, the guy I mentioned, Kiyosaki, he's been kind of doing a lot of different videos, and he's been a big gold and silver guy, but he's also adding crypto. So you brought it up earlier. A lot of more conservative, successful investors in the beginning hated on it. People call it shit coins, or, you know, different terms, and they just trash it. And not all of those guys have come around, but a lot more have come around.
And back to syncretic investing.
Yeah.
Dollar cost averaging into crypto.
Yeah, totally.
Buying pullbacks.
Yep.
You know, it's a market that tends to bring out emotion in people. So applying some of these tried and true techniques that work in the stock market.
Yeah.
They take a lot of the drama out of the crypto market, as does the interest from BlockFi.
I was going to say, what you brought there is really the power of, for me, holding my crypto on BlockFi. And I've turned a bunch of people onto it as well, but because it's like a $4 cost averaging on a daily basis by holding it there.
And for reference here, so if you log into your brokerage account, like a stock account, your P&L is front and center for the day. How much you down, how much you up. BlockFi, you won't find your P&L.
Yeah, that's interesting.
Well, what they will tell you is how much interest you've gotten.
Okay, yeah.
So what's the incentive? The incentive is to hold for the long term.
Yeah.
Now, if online brokerages wanted to do that, they could be like, hey, this is your account value.
Yeah.
And you have to look to find how much you're up or down for the day.
Yeah.
But no, they want you to trade. That's how they make money.
Very true, very true. So let's finish this out. Let's talk about you a little bit here, you know, kind of where you are, and your goals, both for writing, investing, and where do you see yourself in 2023, 2025, 2030? Where are you hoping to go? Where are you hoping to live? What type of life are you trying to create?
You know, just more of the same, just doing it better. I think a lot of people value significance. How famous can I get? How rich can I get?
Okay.
But I really want to place the value on growth. Like, how can I grow? How can I get better?
Yeah.
How can I create good stuff that I can share? And you know, just it's not a dollar figure. It's really the kind of life I want to live. We're talking freedom, location independence.
Yeah.
Obviously cash flow.
Yeah.
But things are going well, and I think they're going to get better.
Yeah. Yeah. So what I'm hearing is you definitely want to continue writing and publishing for Seeking Alpha, doing analysis on companies, and continuing that.
And for North of Sunset, which is my publishing.
North of Sunset. Okay.
Yeah.
Okay. Wonderful. And then in the investing realm, what are your thoughts there? You want to continue like doing a lot of stock investing, or do you want to do some real estate, or what's your feeling there?
Well, all of the above.
All of the above. Okay. Okay.
What I'm looking to publish on next week is some of these quant ideas, like what assets are negatively correlated with each other.
Yeah.
Especially as inflation starts to pick up. There's assets that benefit, and long story short, it's generally banks, insurance companies, stuff like that. And then there's assets they're negatively correlated with, which is like REITs. Same with energy and utilities. Same with stocks and long-term government bonds. When there's value in both. So if you have good value in both, and you have these negatively correlated assets, it takes the drama out, you know?
Yeah. Beautiful. So let's actually finish out with this. So let's say someone's watching this video, they're fairly new to investing. What's a piece of advice, one or two pieces of advice that you can give someone who's new to it, is interested in it, where markets are today, and what type of advice you would give to someone like that?
I would honestly just tell them to read Seeking Alpha. There's a ton of great ideas on there.
Yeah.
And it'll help you learn how people who are doing very well in the markets are doing. And I mean, the principles of investing are pretty simple. It's when people make them complicated that things tend to go awry. And I think this last year has kind of hammered that point home.
Very true, with all the volatility and meme stocks and such.
I've mellowed out as I've gotten older. My investing has too. Not trying to hit home runs. That's very common. I think if you make good decisions over a 3 to 5 year period in business, in your portfolio, relationships, life, they compound. If you make bad decisions and you try to hit a home run, I mean, it'll work for one guy out of 100 who try it, and the rest will. Just compounding good decisions, and a lot of people, they don't even try to invest because they're scared. You don't want to have fear. Just learn as much as possible. There's risk involved, but taking intelligent risk. I think the markets are pretty forgiving if you're smart about what you do and you're not trying to hit a home run. I made a lot of mistakes when I was starting out, and I made a very nice profit along the way. And these mistakes were forgiven just by the upward rise in prices over time in stocks. And I think people who are scared to get in, I think they should consider that. That they don't necessarily need to fear they'll screw up and ruin their lives by investing. Just jump in. You'll get better with time.
Yeah, that's a great point, and that's also why when I was talking about the monthly letter earlier, one of the things I do, and I still do it to this day, is that dollar cost averaging to a certain amount of just vanilla indexes. I mean, someone's a beginner, they could just buy simply DIA, QQQ, VOO, those three sort of vanilla indexes. And sure, someone could argue, well, maybe now's not the time to start, but if you're looking at that 20, 25, 30-year time frame, if you're looking for retirement or capital appreciation, you're likely to do very well. So that's just a simple way of you don't have to pick stocks, you don't have to follow financial media, just buying some vanilla index funds, you'll do quite well over the long term, generally. So, well, listen, thank you guys for tuning in. Would appreciate any likes and comments and questions. Feel free to write, and you can find both of us on Seeking Alpha. He actually writes articles for Seeking Alpha. I just write blog posts where I track my investments for Maneos Compounding Machine. And maybe we'll do this again. It was a lot of fun today, and always a pleasure to have you come to Florida and
thanks for having me down here.
Spend some time with you. So thanks for tuning in, guys.